What is the future of the global economy? Today, we're joined by Matthew Piepenburg, partner at Matterhorn Asset Management and author of several books, the most recent of which is Gold Matters. We're going to talk with Matthew today about the outlook for the US economy, investing both at home and abroad, and much more. So let's start out by saying, Matthew, it's good to have you here. Welcome to the program.
Well, thanks, Patrick. I'm really excited to swap thoughts with you. Looking forward to it.
Yeah, what I wanted to do is actually wanted to start out kind of with your perspective. You started Matterhorn, or you're a partner at Matterhorn Asset Management, and you authored several books. One you did prior to COVID, prior to the lockdowns, which is Rigged to Fail. And then your most recent is Gold Matters. What is it that inspired you to pursue this? And what is kind of the goal of Matterhorn?
Yeah, I was, prior to being in Switzerland at Matterhorn, my partner, my various partners, but the founder was Egon von Greyerz. He's kind of an iconic figure in the gold space. And prior to that, I was one of those annoying Wall Street guys, and I was looking at markets, the classic stock bond portfolios and prop desks and working at banks and hedge funds, and I had a very cynical view of how rigged the markets were. And that sounds very sensational, and I get that. I come from the Midwest. I was a scholarship kid to some fancy schools. I had a lot of friends in the military. Lily grew up in Main Street America. And what I saw in Wall Street, not just the distortion of salaries for abilities and the inside game, I don't want to say completely illegal, but the relationship between the central bank and the commercial banks and the liquidity and the market makers, it really wasn't necessarily a full inside job, but it was a very disillusional experience. It was a very educational experience. I got very, very lucky because I was in during the dot-com bubble of the late 1990s, early 2000, before the NASDAQ imploded pre 9/11. And I basically won a lottery ticket without knowing much, to be honest. I had smart partners and some smart opportunities on an IPO. But the short answer was I really learned how the stock and bond market was effectively subsidized by the central bank and insider trades between commercial banks. I'd say insider in the sense that there was direct fraud, but they had massive advantages of liquidity, massive advantage with market positions, massive advantages with making markets. And so I wrote a book called Rigged to Fail, which kind of discussed how that works, how central banks and commercial banks work, how the bond market is manipulated, all kinds of fancy Wall Street lingo, which I tried to make common sense simple for anyone, because I know you and a lot of listeners maybe didn't grow up in the markets, and I didn't either, but I learned it. And I wrote Rigged to Fail about that system. And of course, the markets did fail in March of 2020 in a major way. I didn't predict it. It was driven by the COVID hysteria or crisis. But that was interesting. But to your question, how I got into gold, which I had never thought of for many, many years. I was your classic stock bond jock, trader, hedge fund guy, annoying guy. But whatever wealth you have, whether it's $1,000 or 1,000 times 1,000 or 100,000 times 1,000, whatever wealth you have, it's measured in dollars. And of course, the dollar is the world reserve currency. It's an important currency, but its purchasing power is getting weaker by the day. And that was something that interests me because we print so much or mouse click so much money out of the Fed that the actual value of that dollar is getting empirically weaker. And we can discuss that and how that happened. But when I realized that whatever wealth you have, however you measure it, is still in dollars. And that dollar became a focal point of my thinking. And there are many ways to protect against the debasement of the dollar or the overproduction of the dollar. There are many debates about it. Gold is only one of them. It's not the only one. Some call it a pet rock, a barbarous relic, something outdated. There's a big debate we'll get into about Bitcoin versus gold. I'm not against Bitcoin either. I'm very conservative and very intellectually curious about money, currency, and what that means. And the short answer is I started thinking about what's the value of my dollar in my portfolio, in my checking account, or in my wallet, and how do I protect that from further debasement. I joke often, if you have a good glass of wine and you add a bucket full of water into that wine, you lose the value of the wine. It dilutes its value because of central bank policy, because of printing money at every crisis, we're devaluing or diluting our US dollar. That's my strong belief. And it's historically confirmed, it's empirically confirmed. So I started looking at gold just because I was trying to protect. I wasn't trying to get rich, I wasn't trying to speculate. It was purely insurance for currencies that were openly dying. And we have health insurance, we have car insurance, we have home insurance. Currency insurance became a thought for me. And so I discovered and spent a lot of time about why gold. And then when I met with Egon von Greyerz, who's a real iconic figure in the space in Zurich, he not only understood why gold, but how to own gold, how to own it outside of your own zip code, how to own it in physical form, not in paper form and ETF form, how to not store it at a commercial bank and the risks in that and the risks of ETFs. So once I understood why I should own gold, the next question was how and where I should own gold. And that became very important. And what Egon built at Matterhorn since the turn of the century is pretty exceptional. And it's not for everyone, Patrick. Our clients are high net worth from 90 countries. And it's in a very secure vault, the safest vault in the world, in an undisclosed location in the Swiss Alps. But that doesn't mean we can't talk about gold for your listeners and ways that they can own gold anywhere in the world. They don't have to come to some fancy zip code in Zurich or Switzerland. There are ways that we can talk about that your listeners can think about. They don't have to take my word for it. They can think about it. But certainly, once I understood why I should have some gold, my next question was, well, how do I own it, and how do I not own it? And that's how I came to Matterhorn, originally as an investor, and then eventually as a partner, which is where I am now. And couldn't be happier because I actually completely believe in what the product we offer and the service we offer. But most importantly, I believe in physical gold as one antidote to incredibly debased currencies in the world, and the US dollar in particular. So that's how I got to Matterhorn.
When you mention Matterhorn, being a vehicle that essentially helps clients protect and preserve their wealth, right? Part of which, I guess, is investing in gold. What is your outlook on the US economy? We could even say on the global economy over the next 10 years. Like, in what way do you see gold playing an important role in someone's investment portfolio in order to, grow their wealth, say, over the long term?
Yeah, it's an important question. I'll caveat by saying there are a lot of folks in my industry, a lot of pundits, a lot of experts who you can find all over YouTube, the good, the bad, and the ugly. There's a lot of sensationalism in their views on the markets and their views on the next 10 years, the next 10 minutes. Seems like every headline, even stuff that I've done interviews, someone will take it and then put a new headline on it. The world is over, implosion, end of days, end of the economy, end of America. There's no need to be that sensational, and I'm not one of them. However, I am considered more dark than most, and not because I want to be. And I look at the data, and maybe I'm biased in what data I look at, but it's pretty simple, stupid, because the stupid really is that simple. Currently, the short answer is markets and economies go up when there's easy money, when interest rates are low and central banks are creating money out of thin air to support the markets. The stock market goes up and the economies do well, but that just buys time. What I'm seeing now, as the Fed raises rates and cuts the money printing down, tightens, that's called quantitative tightening, and as Powell raises interest rates in an inflationary backdrop, it's a double whammy for most citizens, for everyone, but specifically the middle class. Because inflation, they may say it's 3.2 or 3.7%. That scale, it's an open secret on Wall Street, is bogus. I say it's as bogus as a 42nd Street Rolex. Real inflation, if you use the scale with Volcker measured inflation in the 1980s or early 90s, would be closer to 11% now, which is what most Americans feel. Things feel at least 11 to 12% more expensive. The Bureau of Labor Statistics and the Fed don't report it that way. They report it with a very tweaked scale. So with inflation over 10% in double digits, and then interest rates going up, that's a double whammy. So you have the invisible tax of losing 10 cents on the dollar every day, and then the cost of everything is going up. Your credit card debt, the average American credit card debt is 20%. That's not sensational, that's just a fact. And car loan delinquencies and repo men are running around America from LA to New York, taking people's automobiles. I say the middle class is being particularly ignored and particularly hit hard. Corporate debt is up 22%. We had 400 bankruptcies this year. It's double the pace of last year. The top 20 of those bankruptcies are responsible for 200,000 jobs. You've got major companies like Microsoft and even Goldman Sachs or Spotify doing layoffs. So with the combination of layoffs, bankruptcies, rising rates, and higher inflation, it's not a positive outlook. And even the stock market, which lost 15% last year and is trying to come back this year, is being described as resilient. It still hasn't made up its losses from last year. And it's just important to keep in mind, again, this may sound cynical, but the S&P 500 is really led by 7 mega cap companies. The other 493 companies are in the negative, and the top 7 are in the positive. And the most probably galling thing that bothered me then and especially now, again, keeping my grassroots Midwestern perspective and keeping myself honest, when the S&P recovered since 2008 great financial crisis, it's this massive amount of money printing, liquidity, quantitative easing is the fancy lad term for it. You're putting trillions and trillions of tailwind artificial money into those markets. Markets were up over 600% since 2009. But empirically and mathematically and objectively, the only beneficiaries of that massive bubble in the market, which isn't the same thing as the economy, was the top 10% of American wealth. In other words, there was a massive amount of wealth inequality. There was a massive wealth transfer in just the last 15 years since the great financial crisis. To me, that's inherently flawed. That's inherently rigged. It's not meant to be sensational. It's not meant to even be an apology for a guy who used to work on Wall Street and feels bad about it. It just is what it is. And I think many of your viewers don't feel like the economy is too strong. They probably don't feel richer this year than they did last year. They probably don't feel too good about what happened to their small businesses during a lockdown. They probably don't feel too good about current politics, left or right. And so my outlook is simple. We've been living off of trillions of printed tailwind artificial support from a Fed since 2009. That's not a sustainable economic policy. Our GDP is not growing. And when they say it is, it's only because our deficit spending is growing. So we're just spending more debt. And to me, debt-based growth isn't real growth. Our middle class is all but vanished. The really, really poor get handouts. The really, really rich don't care. And the middle class are just getting clobbered. That's just a fact. And I have strong reservations about that. And I think there are very few options left for them. But my view is the economy turns on a switch. When the Fed is accommodative, when they keep rates low and they print money, yeah, markets go up and the economy feels stronger. But that's just like printing money doesn't make you richer, just like printing diplomas doesn't make you smarter. At some point, I think all of us, whether we're dabbling in the markets, whether we spend our career in the markets, or whether we know very little about the markets, all of us have a common sense realization that A, the system isn't working for everyone, that B, printing trillions of dollars to pay for our own bond markets or to support the S&P doesn't seem like a real solution. It feels like a counterfeit solution. It's like legalized counterfeit. And I use the analogy, if any of us could legally go down into our basement and go onto a computer and just add a 0 or 2 zeros or 3 zeros to our checking account whenever we needed money, whether it was for a mortgage, tuition, a car payment, or a vacation. If any of us could do that legally, who wouldn't do that? Of course we would do that. It'd become very addictive. Of course, it's illegal and it's fraud and it's counterfeit. But ironically, that basically in a nutshell is the policy of our central bank. We can literally mouse click money out of thin air to support the stock and bond market and to pay for Uncle Sam's IOUs, the 10-year treasury, the 30-year treasury, the 2-year treasury. Uncle Sam can keep issuing debt and we can keep paying for it with money we create out of nowhere. And that's because we are the world reserve currency, because we have a major power, we can do that and export that inflation to the rest of the world. But eventually it comes back to us. That's my strong opinion. The reason we're having inflation now isn't because of COVID, it isn't because of Putin, it isn't because of little green men from Mars. It won't be because of Afghanistan or Israel. It'll be because we literally, as a government, are spending way more than we earn in tax receipts or GDP. We're living well over our skis in debt. And eventually, and don't ask me when, but in the next 5 to 10 years, I think sooner, those bubbles pop. The middle class is always the first to get hit, like they're the first to get drafted in a war. It's always the same. I hate to be cynical, but they're the plankton of the Wall Street whales. And it's not right. And unfortunately, there are no easy solutions. There are no get rich quick solutions in a market that's highly overvalued today. It's been overvalued for years. Anyone trying to come into this market to speculate to preserve wealth is buying at a top. May not be the top. Nobody knows the top. Nobody knows the bottom, but it sure looks, smells, and feels like a top to me. And it can go on longer or it can turn on a dime. And that's the key question. How do you speculate in a market that's overvalued? How do you speculate in a market where interest rates are going up and there's pressure on bonds? And how do you speculate in a market which is really led by 7 mega cap companies, which when I was in law school, antitrust laws like the Sherman Act or the Clayton Act, I thought prevented this type of monopoly power. But that's, again, rigged to fail. There's so many things wrong. And I'm a patriot, and I believe in America, and I believe in capitalism, I believe in free market price discovery. There's so many things wrong with our system that anyone who takes a few minutes, reads a few books to understand it objectively, not just my cynical perspective, but to understand objectively, starts to feel like they're being had a little. And again, that may sound sensational. I understand that, but I think the markets are headed for an inflection point. Like we saw in 2020, markets went down by 36% when COVID crisis started and bond crisis started. The Fed responded by printing trillions, 4 trillion in a matter of 12 to 16 months. That's a steroid. That's all it was. It bought time. That market in 2020 would have gone down, in my opinion, by mean reversion 50, 60, 70% easily. The only thing that kept it alive, the only thing that saved it was unbelievable, unprecedented, record-breaking mouse click money, adding zeros at the Fed, just adding zeros. If you think that's a solution, you believe that's sustainable, you can be bullish. I don't think it's sustainable. I think eventually it does, like that glass of wine, destroy the currency. So even if the markets go up, the purchasing power of your $20 bill, your $50 bill, your $5 bill just buys you less. So you may be making money on a rising market, but markets rising on fake money means you're rising on diluted money. And again, that's why gold, or to some people, Bitcoin, is one way to protect your purchasing power, or at least try to protect what you have. And I realize that not every person can just go out and buy gold. Premiums are high, the gold price is high, but it's not a get rich quick asset. For me, at this point in my life, it's only preserving what I have. It's standing still. So even if gold goes up in price from 2,000 to 5,000, doesn't make me twice as rich. It means a loaf of bread will probably cost $50, or a car loan will be at 20% interest rates, or a car will cost me more. And that's the problem. It's just trying to tread water with an asset like gold to protect the purchasing power, to ensure the purchasing power. But I think markets are going to be very volatile. To me, it's very simple. When the Fed is printing money and keeping rates low, markets will go up. When the Fed is tightening and not printing as much money and raising rates, the markets will struggle. And right now, everyone thinks the Fed has stopped raising rates. They've paused. Maybe they'll start cutting rates. And then when the Fed starts cutting rates, the markets will go up again. I think the Fed will not cut rates or start printing money at major volumes until we see a real crash in the markets first. A 30, 40% mean reversion, a repricing, what we call a correction or a massive drawdown. I think when markets go down 30 or 40% like they did in 2020, and I think they will again, when that happens, that's an opportunity to buy. That's an opportunity to speculate. Right now, you're buying at the top, although you could argue, and many have, that, well, the markets will never go down. They'll just keep printing money, so they'll keep going up. And that's a dangerous speculation. That's a dangerous bet to make right now. You got to be very cautious. If you have an advisor, make sure they're actively managing. They're not just buying diversified stocks and diversified bonds. Make sure they're doing more than just promising you return, that they're thinking about risk. It's an extremely hard time right now to try and make money in a market that's near a top, that's artificially supported and incredibly fragile, very fragile. I don't want to say just sit on cash and do nothing, but it's a real hard time. I've never seen a more difficult macro environment to try and protect yourself when there's so much distortion in the markets. Patrick, I hope that gives some clarity, but I know it's a big answer to a big question.
No, it's good. It's that's a good kind of overview. I like your candor about you saying, hey, you tend to be a little bit more on the darker side of predictions, because you're looking, like you said, you're looking at data.
You're looking at history, you're looking at, data, you're saying, hey, what do we see coming? I guess my follow-up question to that would be, especially for the middle class, since that's who we're really trying to, assist the most.
Yeah.
How, in addition to, say, buying gold or silver and having that kind of alternative form of cash on hand, how would you, what would you foresee happening in the next 10 years, and how would someone prepare for it? And before you answer that, let me just say, I think a lot of experts are hesitant to talk about this topic because it sounds very doomsday-ish. And that, ends up kind of, just essentially something that a lot of experts try to shy away from.
Right.
And I like I said, I appreciate your candor. What is it that you think is the best way someone, either a small family, could it be a business? What's the best way for someone to prepare for what you see, say, in the next 10 years, 5 to 10 years?
Egon, my colleague, says predicting is always a mug's game. I thought the Fed would cut rates before last Christmas, and they didn't. So even the people that look at the data think they know. We don't really know. What I do know is when I look out the window and I see storm clouds coming, I don't know if it's going to rain at noon or at 3 or at 7 p.m., but I think I need an umbrella. And I can't predict when it will rain. And yeah, guys in the precious metals in the gold space or commodities or real asset space are always gloom and doom. They see the data they want to see. They don't look at the positives. I really do try to look at the positive because I see storm clouds coming. The advice I give to the middle class, like to my own daughter who's 28, my son who's 26, or to my own parents, is, well, my parents don't have the same luxury. It depends on where you are at your age and your income level too. But first of all, yes, I do see the biggest power in markets is mean reversion. It's like a rubber band. You pull it up or you pull it down from your finger. If it's too low, it'll bounce back up. If it's too high, it'll come back. Markets are way up here. They're going to mean revert, even if the Fed tries to keep supporting it. If they mean revert, that means, and I don't know when, whether it's tomorrow or a year from tomorrow, I think the secret to making money is doing nothing sometimes, being incredibly patient. When everyone's at the golf course or at the batting cages telling you they're making a ton on Google or Amazon or some other stock. And, you can't trade on a macro view, but you can. I've always seen the most fortunes were made when I look back from the dot-com bubble through the great financial crisis to today. Most fortunes in the market were made at a crash or when there's blood in the streets, as Baron Rothschild said. Not a big fan of his, but it's a good point. You have to wait for markets to mean revert. You won't time the bottom. You won't know the bottom, but you'll recognize you're near a bottom. To buy at a top, which every grandfather and uncle tells you, buy low, sell high, son, and no one does it. No one does it. My advice to my daughter and my son who are in their 20s, because they can't afford to wait. They don't just have to do something. It's like combat. Everyone and I've known many, 98% of military life is boredom and 2% of sheer terror and exhilaration and itchy fingers and pure adrenaline. And the markets are the same way. Most of the time is at camp, hanging out with your buddies. And then there's 2% time of extreme combat. It's the same with markets. You wait for the opportunity. It's like when you go hunting, you don't just walk out in the woods with a 12 gauge and shoot at whatever moves. You have a target. It's either a deer or a pheasant or a duck or whatever. You have to have a target. And my target is I wait to buy at a low. Right now, we're clearly not at a low. A dip is not a low. I wait for a real low, like a 2008 or a March of 2020. When March of 2020, I saw 36% decline in the market. I thought it'd go to 50 or 60, but then the Fed announced they were going to start printing trillions of dollars. And I was full speed, gas floor, going long the market because the Fed is your ally there. They're printing money and there's been a huge drawdown. That is your time. You have to wait. If you're trying to do this yourself, you have to be patient. And no one wants to hear that. They're like, Matt, give me a good stock, give me a good sector, give me a good trade. Unless you're a professional trader, that's not going to help you. And if you were, you don't want my advice anyway. At a global level, and because I am very cynical, it's also proven by history, common sense, and Bloomberg charts, these markets will go much lower. I do not know when, but it will be soon enough for those who are patient to be on the cash, be on the sidelines, wait for a real bottom. Do what your grandfather, your dad told you, buy low. Nobody on Wall Street does it. Very few people on Main Street do it. Most of your advisors don't do it either. They get paid to churn. They get a fee by keeping your money in an account, up or down. They're getting the same fee. If you want to be contrarian, be a sniper. Think carefully, be patient, wait for that bottom. If you don't think a bottom's coming, do your own research, read things besides me. I know I'm more dark, I'm more bearish than most, but I can afford to be bearish because on Wall Street, if you work at Goldman Sachs, you work in a hedge fund, you've got clients, you don't talk about bearish things. No one gets promoted by being a bear. But all the money on Wall Street's made by taking advantage of bear markets when things are cheap, not when they're expensive. And it's the suckers that buy high, hoping it goes higher. And they may be lucky for a month or a year, and then they lose all their gains in the next drawdown. We've postponed those big drawdowns by money printing, but it's unsustainable. It's like being on, it's like being on six pack after six pack after six pack. Eventually, you're going to get a hangover. This market's been on six pack after six pack after six pack of Fed support, easy money, and low rates. Now we're nearing that inflection point where things are starting to break. Like I said, on Main Street, we're seeing it with unemployment. We're seeing it with inflation. We're seeing it with higher interest rates, higher debt costs, higher credit card debt, higher car delinquencies, higher bankruptcies. It's not a theory. It's happening right now. The market will turn, in my opinion. And again, I don't know when. I don't have the date. I just see the rain clouds. I'm waiting for that 30, 40% drawdown, which may seem sensational. And even if I buy at negative 30, the markets might go down another 10, another 20%. I might not even time the bottom, but I'd rather buy low than high. And so my advice is, and it's not really, because I can't give specific asset class advice, specific stock advice. Can't even do it legally because I'm FINRA registered over the internet. But I can give you the most general thing that maybe people think is Pollyannish or common sense, but no one does it. Wait for a good buy. If you have to be constantly in the market and you're a professional trader or you're an amateur trader, well, then you don't need my advice. Or if you've already got an advisor, like I said, make sure your advisor is thinking about risk first, has a lot in the cash on the side, and short-term duration cash equivalents, T-bills that are giving you at least 4 or 5% yields right now. Wait for combat. Don't start shooting when there's nobody in front of you. Wait until they're marching within 40 yards. And I know it's trying to be flippant, but in Wall Street, it's the same way. Wait. Some traders can't wait more than 30 seconds. But they have tons of algorithms and tons of signals and tons of support. But for the average middle class investor who's feeling out of the touch, out of the loop, out of luck right now, if they have money to put in the markets, sometimes doing nothing is the hardest thing to do. And I know that when inflation is eating away at your savings account, doing nothing feels really stupid. And if I'm wrong and markets rip for 10 more years up into the north, well, then you've lost an opportunity. My opinion is that these markets will crack. The only thing that I would look at that would be against that is if the Fed starts announcing more support, lower interest rates, more money printing, there will be a shock up into the north. The question is, how long can they sustain that? How many six packs can they keep drinking? Can we keep drinking before we all have a hangover? And the problem is, because the Fed is the market, because everything depends on how much money the Fed prints and how much the interest rates are, we're all waiting to see what the Fed does. We're no longer looking at balance sheets of companies, profit or loss statements, financial statements, sound management. We're just looking to see, is there a tailwind from the Fed or is there a headwind? That's the market today. It's not my dad's market. It's not my grandfather's market. It's really hard to speculate with intelligence in these markets. It's really unfair. And that's why I wrote Rigged to Fail, because in my opinion, it is rigged. It's rigged against the middle class and it will fail. The problem is no one really knows when. And I've never seen an experiment where central banks can print trillions of dollars. Just like I said, if you could print money in your basement legally, how long does that last until you get caught or until you destroy the value of your currency? When you're doing it at a family or individual level, printing 100,000, 200,000 a week, that may seem extravagant. You can get away with that. But if you're printing trillions and trillions a year as a government, the question is, how long can that last? And a lot of Americans are rightfully saying, yeah, but we're still the best horse in the glue factory. We're still the US dollar. We're still America. We have a massive military. We have a massive geographical advantage. We have farmland. We have natural resources. We have this incredible, iconic country, the flag on Iwo Jima, the generation that defeated, fascism in Europe. And that iconic America is the America we're all proud of. And I'm certainly proud of every single member of the military. I think they're lions being led often by donkeys, but everyone who puts their life at risk to serve their country and to take that kind of risk deserves a better America than the debt-soaked America we're in now, in which I strongly believe that the middle class, of which the military is a large part of, are the most overlooked, from the VA to their stock portfolios. I just believe that because sadly, where I grew up, most of my friends went to the military. They were in Iraq and Syria and Afghanistan. Many of the guys I went to at fancy schools went to West Point and the Naval Academy, and they were off. And they come back with very little opportunity. And so it's a very important question. I wish I had an easy answer and said, well, buy Bitcoin or buy gold and you'll be rich in 10 years. It's simply not that easy anymore.
Right. Yeah. You know what? I was thinking, Matthew, I liked your analogy of, you don't want to just go out and start shooting. That's a great analogy, especially when it comes to hunting or even to, fighting in an operational environment. You need to be patient. We always, and I'm sure you're familiar with that whole term, tactical patience, that a lot of military, really were born and bred with.
Yeah.
One of the things I think is important is, and you brought it up, a lot of our viewers are actually either active duty military or veterans, and tailoring a little bit to some of what they do. I know you may be familiar that government employees have a retirement plan or retirement program called the Thrift Savings Plan, and that enables them to invest in kind of a very broad-based stock, bond, T-bill. It's kind of limited. There really isn't a precious metals option in there. I mean, there isn't one. How would you recommend someone in the military saving for retirement wants to own some gold or silver? What's the best way for them to do that, in your opinion? Again, we're not giving individualized financial advice.
No, of course. I can see some of your viewers rolling their eyes when you look at our organization, for example, in Zurich, Switzerland, home of the ultimate wealth. And, our minimums are 5 million for our vault in the Swiss Alps, and they're 400,000 for our vault in Zurich. That is not the everyman's gold investment. I totally am aware of that. But Egon and I said, even though 98% of the time we're talking to people who could never afford our service, everyone can afford gold and silver. So I'm talking to people who aren't going to be my clients. So I'm trying to be objective here. My uncles were, my family, all veterans. I remember my uncle, when I was 10 years old, taking me aside, giving me silver dollars and gold coins for my birthday, and me just wanting to go buy a Snickers bar with it because I didn't understand what he understood. And yet it's no different than what Egon and I are telling our millionaire clients. Gold is a good investment. You can buy gold coins at a reputable dealer anywhere in America today. And I don't think gold's going to be confiscated like it was in the 1930s. The problem is you're going to pay premiums right now on that gold. And gold doesn't go up in a straight line. You may buy it at 15, 18, 1900, then it goes down to 1700 and you feel like an idiot. Gold is something you hold and you never look at again. Never. You hold it to preserve. In Switzerland and Germany and Austria and where I am in Europe, countries that have seen war, that have seen inflation, that have seen currencies move like gyrating yo-yos, it's not at all uncommon for a farmer or a millionaire to have 20% of their wealth in physical gold, because ETF gold is not your gold. It's custodied in a bank. That bank has operational risk. They use leverage. There's intermediary counterparty risk. It is not, in our opinion, whether you're a millionaire or a shoe shiner, it's not the best way to own gold. It's a good way to trade it if you're a hedge fund guy, you're just arbitraging the gold. If you want to own gold to preserve against inflation risk or currency risk, you just have to buy physical gold, like my uncle taught me to do with coins, where I didn't understand it. Ironically, he was smarter than me way back then, and I'm some fancy executive in Zurich, where my uncle figured it out a long time ago. And it goes back to this notion of, again, am I exaggerating? When does combat make sense? When are things tactically not patient and overtly stupid, like Pickett's charge on July 3rd at Gettysburg, or John Bell Hood at Franklin, Tennessee? These insane, or Grant at Cold Harbor, insanely stupid attacks, frontal assaults into an entrenched position. You've got to avoid that kind of impulse and be patient and flank. And I think gold is a flank. It's not the only solution. And I don't suggest you put 100% of your savings account in physical gold. And when you buy coins, you have to make sure it's from a reputable dealer in the US. There are many here in Europe. You're still going to pay a high premium. You're going to feel like a sucker, and it's not going to make you rich overnight. And I certainly don't recommend the bulk of your wealth, but 10, 20%, if you can afford that. I'd much rather have physical gold than a stock certificate in an overvalued stock market. And again, I'm not saying that because I think your clients or your listeners are going to be my clients. That's what I believe. Silver is another way to go. It's, again, very undervalued right now. When gold rises, silver rises much faster. So that's more of a speculation play. But again, silver can also sink faster. So you have to have a strong stomach. It's not for widows and orphans, just like Bitcoin isn't for widows and orphans. Gold is pretty unsexy and pretty boring. And I'm in a preservation mode now. We can talk about speculation plays too, but for those just trying to keep their nose above water, some allocation to physical gold, to me, it makes as much sense from a fancy Zurich office as it does from my uncle on my birthday giving me silver and gold coins. It's a funny story. Recently in Kentucky, they found a bag of Confederate gold coins in the ground. The lucky guy with with a metal detector was worth millions. But in 1864, when probably Adam Morgan or some guy was stashing some of his Confederate gold in the ground because the Union Army was coming, if they had just dumped a bag of Confederate cash and you dug it up 160 years later, it'd still be worthless. It might have some museum value, but that Confederate money would be useless. That paper money would be useless. But because they had Confederate coins, that's far more valuable than a museum piece. That has inherent purchasing power value. Gold always outlasts paper money, whether it's Confederate money or even the world reserve currency in the US dollar. There are many who'd say, Matt, the world reserve currency will never die. It's the American dollar. It will always be the best horse in the blue factory. And they're right. I'm not against the fact that the US dollar is relatively stronger and more effective than any other currency, but its inherent purchasing power, since we got off the gold standard in 1971, Nixon needed to get elected. Our dollar was pegged to gold. We didn't have enough gold for him to create more dollars, so he simply cut the gold standard off. That allowed him to print unlimited amount of money. But since he did that in 1971, the inherent purchasing power of the US dollar measured against a milligram of gold has lost 98% of its inherent purchasing power. That's not a gold bug sensational story. That's an empirical fact. In the last 50 years, our dollar has lost 98% of its purchasing power against gold. To me, that's the most common sense argument why I own gold, because the dollar is no longer chaperoned by gold, which means we can create unlimited amounts of it. It's like I say, if you leave your teenage son at home without a chaperone, he's going to throw a hell of a party. I would, you would, anyone would. The parents are away, the cats will play. And when Nixon welched on the gold standard and everyone thought a dollar was redeemable, with gold, it isn't anymore. So you have to create your own gold standard. No matter how modest or immodest or how much wealth you have, you can create your own little gold standard and back your currency with some gold. And again, I'm not saying that to make your viewers a client of Matterhorn Asset Management. Our minimums are too ridiculously high, but I still believe in gold. And I still have my children. They're still buying ounces of gold every month. Part of their paycheck goes to buy physical gold, not because they're going to get rich, but just because the dollar in their wallet's getting weaker by the day.
What is your thought about, let me just first off saying, I completely agree with you about gold being a great hedge against inflation, and really economic uncertainty too. But what would your response be to, a lot of financial advisors will say, well, the stock market is a hedge against inflation too, right? Because stock prices go up, and they'll say over the long term, if you take that money that you put in gold and you put it in a stock index fund instead, you're going to maybe even do better.
No, it's a very fair point.
As far as being a hedge, when we say something is a hedge against inflation, why is gold a better hedge than, say, a stock index fund?
It's a very important point, and many will say empirically gold is not a good hedge against inflation. Gold doesn't outperform the S&P. What are you talking about? It's a pet rock. It's a barbarous relic. You're just a gold bug. You're just selling me gold. And believe me, the last thing that any of us talked about on Wall Street during the dot-com bubble or the roaring 2000s, no one was talking about gold. Only 0.5% of the world owned physical gold. It's a couple things. By the way, a good Nolan Ryan baseball card when he was playing for the Astros is probably worth a better hedge against inflation. Gold's not the only thing that holds its value better than a dollar. There's a couple points I'll make, and just it's a simple example. Egon von Gruyter is my partner when he started Matterhorn Asset Management back in the 2000s. In 2000, he was buying gold at $250, $300 an ounce. Today it's at $2,000 an ounce. Today it's like $19.98 tonight, whatever. We don't even look at the daily price. Since he bought gold, clearly it outperformed the S&P in an inflation-adjusted basis. It was an exceptional hedge against inflation. More importantly, it outperformed the S&P. But if you just take that statistical window 3 or 5 years back, it may not. So it depends. Any statistician can say, well, gold is better than a stock if you look at this window of time. In the window of time since Egon von Gruyter's bought it over 20 years ago, it has definitely outperformed the S&P on an inflation-adjusted basis. The other point I would make, and this may sound sensational, is the inflation scale that we use to measure inflation. It's an open secret on Wall Street. This is not me trying to be a kook conspiracy theorist in my mother's basement watching too many YouTube ads or Google videos or Google ads and YouTube videos. It is known that the inflation scale is bogus. It's like I say, it's like going to a fat camp where the scale that measures your weight, they feed you pizza and chocolate and beer 24/7. You jump on the scale, you look down, you're clearly fatter than you were yesterday, but the scale says you're losing weight because the scale doesn't measure calories from pizza, beer, or chocolate. And the way that Bureau of Labor Statistics measures inflation is it takes out all the things that are expensive and rising in price and recalibrates it so it looks like we're not having higher inflation. It is literally data manipulation. And I know that sounds sensational, but we, again, as I said, we know that inflation is much, much higher than reported. So when people say gold is, inflation adjusted markets are doing better than gold, well, actually inflation is much higher than reported. So actually, your bonds that give you 5% when inflation is 10%, you're losing 6%, 5% just holding a 10-year treasury. But Powell will tell you you're only losing 3.2%. So you're making 1%. I say you're losing money. And by the way, for many years, you were inherently, even without inflation, you were losing money. When a bond gives you less than inflation, in other words, when inflation eats away at your bond and you're getting a negative return, that's actually technically a defaulting bond. So there aren't many good hedges. Gold, depending on how you measure inflation or on what window you look at, you can find someone who'll shake his head and say gold doesn't beat the S&P and it doesn't beat inflation. Again, keep it simple, stupid. Think of the dollar since 1971. Think of what a Big Mac cost you in 1971 and what it costs today. Do you want to do you want to pull out a dollar? Would you rather have a silver dollar or a gold ounce? It holds its purchasing power infinitely better than any paper money, not just today, but literally throughout history. There is no exception. That's why people say it's a pet rock or a barbarous relic. It's so simple, stupid. It's like a glass of water. When you've just done a 20-mile march or a 10-mile run, water is actually pretty refreshing. Gold is pretty simple. It's not sexy. It holds its purchasing power far better than any fiat currency in the world, including the dollar. That is never going to change, in my opinion. It certainly hasn't throughout history. Throughout any time in history, every debt-soaked regime, monarchy, kingdom, nation, democracy, once it's over its skis in debt, it debases its currency to pay for its debt. That creates inflation. It creates social unrest. It leads to a politically extreme left or a politically extreme right and less civil liberties, less personal choice, and less purchasing power in your currency. And that's true of 1930s Weimar, 1990 Yugoslavia, 1889 Napoleonic France. It's going to be true of the US too. It's already happening. The purchasing power of our currency is getting weaker. Gold is just one solution to that. To your question, is the S&P another way? Yes, if the Fed prints trillions of dollars, that should make stocks go up at a consistent level, as they've been doing ever since 2009, really, since we bottomed after the great financial crisis. Stock market's ripped. And most advisors who are consensus thinking will say, just hold it out, bite a stick, carry the volatility, stocks will go up. And yeah, your purchasing power may be getting weaker, but you're getting better returns. It's a very dangerous assumption to make. It's one potentially good assumption. For me, it's not a good assumption. I think stocks will go down. So you're going to lose on the stocks and you're going to lose on the purchasing power. But even if stocks go up, the percentage points it goes up measured against the real inflation that you're losing, you're basically running uphill in roller skates. That's the problem. But you're taking more risk right now in the stock market. Again, my advice is to wait for a real 30, 35, 40% correction before you then use stocks to hedge against inflation, because at least you're buying near a bottom. And that requires patience. That requires tactical patience. But your advisors, and I'm not saying they're all bad, your typical, brick and mortar advisor, online advisor, they have a vested interest in telling you to stay always in the markets. They get a fee off of that. They don't want you in cash. They don't want you to wait. But even a good advisor can put you in short duration treasuries and still take a fee. I'm just saying there's a disconnect between their interests and your interests sometimes. And I'm not saying all advisors are bad. They tend to be very groupthink. I think they believe in what they believe. They're taught to believe this. They also will tell you, don't trade on the macros. Don't be gloom and doom. You'll miss out. And sometimes they're right. I'm saying right now in this particular environment, we can all kind of have to make our own gamble there. I think there's more risk than reward in this market. I think you need to wait until you see some real dramatic, not dips, but a real dramatic fall like we saw not too long ago in March of 2020. That's when you start pulling your trigger. That's when you get that itchy feeling. That's when the adrenaline kicks in. That's when you take the risk. Until then, you're going to, again, look at other opinions. Maybe there are people more bullish than me. I definitely don't want to say I'm the only opinion. I talk to a lot of hedge fund guys, though. They're more bearish than me. And another thing I'll tell you, just it's not an insider secret. It's just an anecdote. A lot of the wealthy Park Avenue hedge fund managers that I know who trade stocks for a living every day and get their 2 and 20, they don't trade gold in their portfolios that their clients are in, but with their own money, their own unearned lottery ticket money, they're buying physical gold all over the world. That's what the smart money's doing. And I'm telling you that that's what we see every day. The wealthy are buying more and more gold and getting out of the markets and waiting for a good opportunity to shoot. They're not chasing their tails because advisor told them just to stick it out. Again, that's my cynical, anecdotal, personal view of what I see. You can take it or leave it. And I think if I sound too bearish, which I may, I invite people to look at more bullish perspectives. They're out there, very few. And there are good managers who can go long and short. The problem is the middle class usually can't find those managers. Those guys are expensive. And even the ones that are expensive, they're not always that good. I'd say 20% are better than the other 80% combined, but they're very hard to find. So it's really tough. It's really tough.
I was going to say, Matthew, so following up on the idea that, owning some physical gold is good. It's a good idea. Mm-hmm. How would you recommend someone say they're active duty, they don't necessarily have a lot of money. They want to put some of their money in physical gold. How would you recommend that they would store that? Would you put it in like a safety deposit box in the bank? Would they keep it at home? What would you recommend?
Well, it's like I tell my son, I mean, there's the Folgers can approach, right? You put it, you hide it under your bed, literally. First of all, it's hard to keep a secret. I wouldn't tell anyone if I were buying gold, whether you have millions of dollars of gold or $10,000 worth of gold. You say that at a bar or a beer and someone overhears it, and then suddenly you just don't know. So they have nothing to lose by coming to your house and getting your 10,000. Once they have the gold, they have the gold. It's very dangerous to hold gold in your own house. If you put it in a safe deposit box, then your counterparty risk is that safe deposit box. That's probably the safest option. Obviously, not everyone listening is going to come out to Switzerland, put it in some huge fancy vault in the Swiss Alps that costs too much money. No one has those opportunities. Very few people do. I respect that. I think, like I said, don't do it in an ETF. Don't hold it at a commercial bank. A safe deposit box is fine, or a safe, undisclosed location that you can trust that you don't tell anyone else about. Because I realize for a lot of your active duty listeners, they don't have the options for fancy banks or vaults. And so it's somewhere in the backyard in Tennessee or Michigan or Virginia. I get it. But you got to be very careful about who you tell and where you put it. People have been doing that for centuries. You just have to be common sense smart. What I would say is don't buy an ETF and think that you own gold. You've got to have the physical, and you've got to be circumspect about where you put it and who you tell about it. We all have to keep certain things to our chest. Just like we have we all have my gun rack right there. It's locked so the kids don't get it. But with gold, you have to be even more careful, I think. And so, yeah, it's a good question, but safe deposit box, as long as it's a trusted location that you can access, as long as that counterparty has been vetted. Commercial banks, I wouldn't recommend. The Folgers can may sound kind of comical. It can be done. It just has to be done carefully. Another advice I would give to members today is, look, in a rising rate environment, try to stay out of debt. And I know that's just worthless to a lot of people who live off credit cards right now because they're just trying to get rent and get groceries. It's an incredibly tough time right now. But trying to avoid debt right now at these levels, wait for rates to come down before you go into more debt. You're just spinning in circles. And unfortunately, though, that's easier said than done because we don't have money printers in our basement. And when they're military, we can't just create money when we want it. And that's what's so unfair. It's incredibly hard right now. It just is. You've got to be patient. You've got to tighten your already extremely tight belt. You've got to fight unreported inflation, and you've got to deal with ridiculously usurious interest costs on your credit cards. And if you're applying for a mortgage, good thing, like you said, as a veteran, you get better rates for mortgages. You get better deals. You get better down payment terms. And even then, I would wait to buy a house, though, until prices come down. In a recession, housing prices should come down. There's a great supply and demand mismatch. Requires patience, requires discipline. A lot of active military members have discipline and patience, and yet they don't have financial savvy. How should they? They're not financial guys. So they got to find a way to educate themselves, look at two sides to every argument. I'm very bearish. Look at a bullish argument. Go with your gut. Look around you. We all have eyes and ears. We see things commonsensically. Ultimately, common sense, patience, and physical precious metals are good choices. It's not the only choice, though. Stock market can be good, but I say buy a real dip, not just a temporary dip. Buy when there's blood in the streets, when people are scared and people are selling. That's when you buy.
I think that's very, very valuable advice. Actually, I want to say, Matthew, all the advice you've been sharing with us today is very valuable for our viewers. If there's anyone in our audience who wants to reach you, they want to follow you, they want to follow your work, get a copy of your book, how would they contact you? What's the best way to reach you or follow you and your teachings and your information?
Yeah, our website is goldswitzerland.com, and there's a contact button under goldswitzerland.com where you can reach me. And anyone who wants to, and I mean this, if there's thousands, I can't be there, but any veteran or any active service person who can reach out to me, I'll do my best to answer them and I'm not saying this for brownie points, as a guy who grew up in Wall Street and was on the board of going to West Point in '88 and have many, many friends and family in the military. I'll just say it. I think our armed services people are better people in the whole than the guys and gals I worked with in Wall Street or see in Davos. So I'll do anything I can to give straight talk and talk to them one-on-one. The problem is there's too many. I can't do it. I can say, read my book. That sounds like a pitch, but I think Rig to Fail and Gold Matters, you can get them for really cheap. But in addition to reading the books or other books, read The Creature from Jekyll Island. That's a long book, but that'll give you a hardcore look at how the Federal Reserve became the fourth branch of our government. It doesn't make you not a patriot to be critical thinking about the system of money we live under and the country we're fighting for. I believe in it, but we have to be critical of it. And read some good books, some bull books, some bear books. I think my books are pretty objective with the data, but I have a very negative, cynical view. But they can reach me at goldswitzerland.com. I'll try to answer emails. If I can get 10 guys together on a Zoom, we can maybe do a group call, talk about markets. I don't have a get rich quick scheme right now. And, Bitcoin is one option. It's incredibly interesting. There's a lot good and bad about Bitcoin. Be careful of its volatility. It moves at huge levels up and down. Wish I'd gotten into it when it was at $10, but I didn't. But it's a speculative asset. It's not the same as gold as a wealth preservation asset, in my opinion. I could be wrong. It could make you some money real fast, but it could also put you in pain real fast. You have to be able to look at your own risk tolerance, your own ability to stomach that kind of volatility. I think Bitcoin will do well in this current environment of volatility and more confusing central bank policies, but it's got a lot of risk in it too. And gold doesn't go straight up and to the right. And even when gold doubles in price, it's only because everything else is costing you more too. So there's a lot of things to think about. And I wish I had an easy answer or an easy strategy or an easy portfolio allocation that would guarantee it. It just doesn't exist right now. I think everything's overpriced. I don't think gold and silver are, but of course I'm biased. But I do think the patience, that's tactical patience, that discipline without losing faith, can hold still. And meanwhile, right now in these high rate environments, this high inflation environment, it's got to be brutal. It's hard to save a dime right now for that group.
Yeah, what I will do is I'll make sure I put a link below this video for that link that you'd mentioned. I'll put that below the video. So if anyone wants to reach you, if we want to set something up, it's a
and of course LinkedIn. I'm on LinkedIn. I mean, you can always find me on LinkedIn. Matthew Piepenburg on LinkedIn. And like I said, if you're an active service member or a veteran, I really will try to organize a chance to talk, for sure.
Matthew, thank you so much for your time. Your advice is very valuable to all of us. We'd love to have you back at some point. And
anytime.
We appreciate what you've done.
All right. Well, thanks, Patrick. Anytime. I'm happy to talk. Anytime.
And to the viewers, thank you for watching. Please remember to like and subscribe.